Did the Biden administration cut a shady deal with the Winklevoss twins' crypto empire, only for the CFTC to come in and try to shut it down? The wheels of justice, especially in the fast-moving world of cryptocurrency, can sometimes spin in unpredictable directions, but this latest development is sending shockwaves through the industry and raising serious questions about the integrity of regulatory processes. Before we dive into the nitty-gritty of this regulatory drama, if you want to stay on top of everything happening in U.S. politics, from the halls of Congress to the volatile world of digital assets, hit that subscribe button right now and leave a like. It really helps this channel grow and ensures you don't miss out on crucial updates like this one. Now let's get into it. The Commodity Futures Trading Commission, or CFTC, has made a significant move, asking a federal judge to throw out a settlement that was reached with Gemini, the cryptocurrency exchange founded by the famous Winklevoss twins, Tyler and Cameron. This settlement, mind you, was inked during the twilight hours of the Biden administration, meaning it was finalized very late in President Biden's term. And the CFTC's reasoning for wanting to scrap it? They've stated that inappropriate tactics were employed to get Gemini to agree to the terms and, in their words, to extract a settlement. That's a pretty strong accusation, and it immediately casts a shadow over the entire deal. For context, Gemini had agreed to pay a civil penalty of $1 million and to take steps to improve its compliance. This settlement stemmed from allegations that Gemini offered unregistered crypto products, specifically the Gemini Earn program, which allowed customers to lend their crypto to earn interest. The CFTC had argued that this constituted the offering of a security without proper registration, a violation of federal law. The deal was seen by many as a significant step in bringing more accountability to the booming, yet often unregulated, cryptocurrency market. It suggested a willingness from the regulatory body to engage and resolve issues, rather than resorting to protracted legal battles. However, the CFTC's recent filing paints a very different picture. They are essentially admitting, or at least strongly implying, that the process leading to that settlement was flawed. They've indicated that an internal review within the CFTC determined that the methods used to push for the settlement were not up to par. This is a remarkable admission, especially from a federal agency. It suggests that there might have been undue pressure or questionable negotiation tactics used to achieve the desired outcome, potentially at the expense of a fair and transparent process. So what does this all mean? Firstly, it throws the future of the Gemini Earn program and its users into further uncertainty. While the original settlement aimed to provide some resolution and restitution, its undoing could lead to prolonged legal battles and delays in any potential recovery for affected customers. It also raises significant questions about the continuity and consistency of regulatory policy. If a settlement agreed upon by one set of officials can be so readily challenged and potentially overturned by others within the same administration, it creates an environment of instability and unpredictability that is detrimental to businesses operating in this space. Secondly, this could have broader implications for how other crypto exchanges and platforms are regulated. If the CFTC is now signaling a willingness to scrutinize the very tactics used to reach previous settlements, it might embolden other companies to challenge existing agreements or to push back more aggressively against regulatory demands. It could also lead to a more cautious approach from regulatory bodies themselves, potentially slowing down the process of enforcement and resolution. Who is affected? Directly, the Winklevoss twins and Gemini are at the center of this. Their business, their reputation, and the financial interests of their users are all on the line. Indirectly, any cryptocurrency exchange or company that has had dealings with the CFTC or is anticipating future regulatory scrutiny will be watching this closely. It could set a precedent for how future enforcement actions are handled and what constitutes acceptable regulatory practice. The possible outcomes are varied. The judge could agree with the CFTC and toss the settlement, leading to a full-blown lawsuit. This could be lengthy and costly for all parties involved. Alternatively, the judge might deny the CFTC's request, upholding the original settlement. This would be a blow to the CFTC's current stance, but would provide some closure. There's also a possibility of a modified settlement or further negotiations. Whatever happens, this situation highlights the complex and often contentious relationship between the rapidly evolving cryptocurrency market and the established regulatory frameworks. It underscores the ongoing debate about how best to foster innovation while protecting investors and maintaining market integrity. This is a developing story with significant ramifications for the future of cryptocurrency regulation in the United States. It's a stark reminder that in the world of politics and finance, yesterday's agreements can sometimes become today's controversies. So what do you think about this? Is the CFTC doing the right thing by revisiting this settlement, or is this just regulatory whiplash? Drop your opinion in the comments below. I read every single one. And if you found this breakdown insightful, make sure to share it with your network. We'll be keeping a close eye on this story and bringing you further updates as they unfold. Thanks for watching.